be the bulk of this section's material. So, allowance for bad debts and bad debt expense. What happens here is, as we've already addressed, sometimes people will buy something from us and they'll promise to pay us later. But also sometimes people don't pay us back, which stinks. Now, if people didn't pay us back frequently, our sales would look crazy because we'd have people randomly not paying us back, or maybe we wouldn't even record that on our books. So we need a way to record when people aren't paying us back. And so that's why we have allowance for bad debts. It's an allowance for those that people aren't going to pay us back on. Now we have some key accounts that we need to know for bad debt accounts. This is the journal entry that's kind of new to us at this point, that we're going to be focusing on as far as like the actual entry. The bad debt expense for however much we estimated, and allowance for bad debts as a credit. Now, bad debt expense is just an operating expense. And it's an operating expense because it's a part of normal course of business to have people occasionally not pay you back when you're selling to so many different people. This helps us reduce the total income so that we don't overrepresent how many sales we made every year. We reduce it by just a little to say, I realize I'm not going to get as much. And so that's why we have that expense. Allowance for bad debts is a contra asset account. Now, if it's a contra asset account, is it a debit or a credit balance? Hopefully you thought a credit balance. Just like with contra revenues, a contra account is paired with its asset or its revenue or whatever it may be. And so in this case, we're going to have accounts receivable on our books. We're going to have a contra asset account of allowance for bad debts. And it's going to directly reduce the accounts receivable, giving us a net accounts receivable number. And so if we had $100 of accounts receivable, we estimated that year that there would be $10 of uncollectible accounts, then we have net accounts receivable of 90. This is important because sometimes they ask questions on the exam, or at least on the practice exam, where they say, what is the net accounts receivable? You don't want to do all the estimation and not remember what net accounts receivable equals. Remember, it's the total accounts receivable for the year minus the allowance for bad debts. All right. Now, these are the other entries that are important to this kind of scenario. We have our normal sales, which is just recording accounts receivable and sales. Hopefully that's very familiar. We have this one, which I just mentioned to you, where we record a bad debt expense to reduce our total income to represent, the sales we aren't going to receive. And then an allowance for bad debts to reduce the total accounts receivable by a little, so we don't look like we're going to receive more than we really are. This is the last one that we need to worry about. Now, with bad debt expense and allowance for bad debt, this journal entry, this is recording an estimate. It's not like we had a company call us and say, hey, you're not going to get my money because I just went bankrupt. This is like us saying, they look like they're going to go bankrupt. I'm going to go ahead and record that we're probably not going to get this. If they actually go bankrupt and you know that they're not going to pay you, then what you do is you write off some of these accounts receivables, meaning you directly reduce the accounts receivable account. And this estimate account we made, allowance for bad debts, rather than decreasing our revenues directly, we can reduce allowance for bad debts. It almost acted as a shield. And so now what happens is if we had 100 in accounts receivable, we had 10 as our estimate, 90 net. What happens here, let's say that $5 actually went bad. I reduced my accounts receivable by 5. I reduced my by 5. And my net is still 90. And that makes us nerdy accountants so happy that these are equal to each other. That is just so pleasant. And that's why we did it, is we wanted to shield ourselves from the effects of the volatility of whether people are going to pay us back or not. And so that's what this account does. It's the write-off. Now, You've all probably seen this guy. Sorry if it cuts it off a little on the left there. This is just the fancy way that your accounting professors have tried to help you remember what goes on. We have our accounts receivable. We have some amount at the beginning. We have sales. That's that accounts receivable for debit and sales for credit. That's this debit here, it's credit sales. Keep in mind it's credit sales, not total sales, because if someone just made a normal sale and they gave you cash that day, you're not going to have any accounts receivable recorded, because that's not an accounts receivable, it's just cash. If we collect cash from our customers who we made sales to on account, then we reduce the amount of accounts receivable. That's this cash collections. You'd see that in an account with debit to cash, credit to accounts receivable. Write-offs we just talked about, they love to do it this way because they conveniently come right next to each other. Decreases the accounts receivable balance, decreases the allowance for bad debts balance. Finally, we have our ending balance. Over here we have our beginning and ending balance for this account, and the bad debt expense, which increases the allowance for bad debts, and that once again makes them happy because they are side by side. So, with all this in mind, we're going to talk about the actual estimation of these. So we have three methods to estimate our bad debt. Hopefully these are, this is just a review and a reminder, so I'm going to go through them quickly so we get to our practice problem. The first method is the income statement approach, or the direct method, and we use credit sales to estimate bad debt expense. And for the sake of time, actually, let me just put all these on one page so we talk about them all, and then we can talk about them using the T-counts. So we have the income statement approach, or the direct approach. We have the balance sheet approach, or the indirect approach. And we have our aging method, which is that big table with all the percents, and we'll talk about that. The reason they call this the income statement approach is because you use the credit sales to estimate the bad debt expense, both of which are on the income statement. And if you think about that, that kind of makes sense. I mean, if you think about a business, they'll look at their total sales they made that year, and they'll be like, what percent of those are going to go bad? Let's just say 5%. They multiply that by 5% and record bad debt expense of that amount that they estimated. So that kind of makes sense. The balance sheet approach, they call it the indirect method because they're going to guess the ending balance and go backwards and find the bad debt expense. And we'll see that in the T-charts next. But the reason we call it the balance sheet approach is we use the ending balance of accounts receivable to estimate the ending balance of allowance for bad debts. Two balance sheet accounts are what we're using to be able to find it. And so keep in mind those names because they'll use them all, the indirect method or the balance sheet approach, and the income statement approach, or the direct approach. The aging of accounts receivable will hopefully be really obvious if that's what you have to do, because like we mentioned, there's a ginormous table that looks like this. That's at the bottom of it. But we'll go to that in a second. Let's talk about the other two real quick with the T-chart. So the credit sales, the direct approach, or the income statement approach, looks at the sales to estimate the expense. The balance sheet method takes the ending balance of accounts receivable to estimate the ending balance of allowance for bad debts. If you memorize this table, these three T-charts for the accounts receivable, allowances, and bad debt expense, I think it'll be really helpful. So if you don't have these memorized, I would encourage you to do that because it's very helpful to remember where everything goes in case you get short on time or you're just trying to remember it a lot for the exam. And so that's how these two methods work. They'll give you a percentage. They'll say 5%. You'll multiply the sales times 5% to get your bad debt expense, and then you'll be able to record your entry of debit to bad debt expense, credit to allowance for bad debts. For the balance sheet approach, or the indirect approach, the reason it's indirect is, like we mentioned, we guess this ending balance. Maybe someone says this is 10% of the total accounts receivable I have left at the end, and they use that percent to guess the ending balance here as saying, you know, what percent of my total accounts receivable at the end am I really going to need to protect myself from? And then from there, we have a beginning balance, we'll have write-offs, and we need to go backwards to find the bad debt expense. So for example, if we found this was 100, we started with 50, then we would have bad debt expense of 50 to make it so 50 plus 50 was 100. If you add write-offs in there, that's just one more addition to the problem. So the last one was the aging method. The aging method is the balance sheet approach split up into a whole bunch of different segments. Think about this table as someone trying to record the number of apples in a basket and what color they are. They say, oh, well, there were 3 red ones, 3 green ones, 2 blue ones, and 2 purple ones. And so we have a total of 10 apples, but we have all this different numbers of the colors of apples. That's what this chart is saying. We have a total of 39,000 for accounts receivable, and we have all these categories that add up to a total of 39,000. In this case, the categories are the age of these. So if we made a sale within the last 30 days, that's this here, this 18,000. If we made a sale that was between 30 to 60 days ago, it's in the next one, and so on and so forth. This table makes sense because if you look, our percent uncollectible that we multiply this by is really small for the ones that are really young or the ones that we recently sold. And it's really high for the ones that we sold a long time ago, which makes sense because we're probably not going to collect those. And so we multiply the amount of receivables for that one section by the percent. We get a total here. And once we do that for all of these, we add them all up, and that's our guess. Now that's, like I said, that is the same as the balance sheet approach because we're taking our accounts receivable, this guy, to guess this guy. So when you add all these up, it's this guy right here. So if you have a hard time remembering that, just remember this is the balance sheet approach split up into all the different ages. That's why they call it the aging method. And so that'll be really helpful. Also, they love to trick students, and they probably already did this on one of your quizzes, by giving you this number, and this number, and then saying, go ahead and solve with the aging method. What a lot of students do is they do this problem, they find this number, they do the subtraction here, and they get their bad debt expense amount. But they've forgotten about write-offs. This isn't really a real world scenario. No one forgets about write-offs, but it's an accounting class test you to make sure you know what you're doing kind of scenario. And so keep in mind that you need to look at this total accounts receivable here of 39,000, plug that in here, and make sure that if you do beginning balance plus credit sales minus cash collections, it equals this ending balance.